240 billion in gold. One signature. $0 involved. Russia and China just executed the largest non-dollar commodity transaction in modern history, and the Treasury Department went silent for 72 hours before issuing a three-sentence statement that said almost nothing. That silence tells you everything. Your 401k, your mortgage rate, your grocery bill, all of it floats on the assumption that oil, gold, and major commodities get traded in US dollars. That assumption just took a $240 billion hit. And if you think this is just about two countries swapping metal, you are missing the architecture of what is being built, while American media focuses on everything except this. This channel runs on no corporate funding, no government backing, and no advertising pressure telling us what to leave out. The analysis that needs to happen about what Russia and China just demonstrated is not happening on mainstream platforms. It is happening here. If this kind of breakdown matters to you, hit subscribe and turn on notifications because the next 6 months are going to rewrite assumptions that have held for 50 years. Let me show you exactly what happened. On March 14th, Russia's central bank and the People's Bank of China formalized an agreement that had been negotiated quietly for 8 months. The structure is straightforward. Russia transfers physical gold reserves held in Moscow vaults directly to Chinese custody in exchange for Chinese yuan and immediate access to Chinese commodity markets without dollar conversion. The total value of the initial tranche is $240 billion, with the full agreement structured to facilitate up to $850 billion in non-dollar gold transactions over the next 3 years. The official announcement came through Xinhua News Agency at 11:47 p.m. Beijing time. The statement was 4 paragraphs. It described the deal as a strategic partnership aimed at enhancing monetary cooperation and ensuring financial stability in an era of increasing currency volatility. The Russian Finance Ministry released a parallel statement calling it a natural evolution of bilateral trade relations that have grown 31% year over year since Western sanctions intensified. Both statements used the phrase mutual benefit. Neither statement used the word dollar. The U.S. Treasury was asked for comment 6 hours after the announcement. The response came 66 hours later. 3 sentences. A spokesperson stated that the United States monitors all significant international financial arrangements, that gold transactions between sovereign nations are not unusual, and that the strength of the dollar remains anchored in the fundamentals of the American economy. That was the entire response. No analysis of strategic implications, no acknowledgement of scale, no mention of the dollar's role in commodity markets. Here is what that response does not tell you. The Treasury Department has a sanctions compliance division that tracks every major commodity transfer that could circumvent dollar-based trade restrictions. That division produces daily briefings for the Secretary. The fact that the public statement took nearly 3 days and contained 0 substantive analysis means one of 2 things. Either the Treasury was caught completely off guard and needed 72 hours to figure out what this means, or they know exactly what it means and decided that saying nothing is better than explaining the implications to the American public. Neither option is reassuring. Now let me show you why the official narrative that this is just routine trade cooperation is incomplete at best and deliberately misleading at worst. Gold trades in dollars. That is not a suggestion. It is the structural foundation of how commodity markets have functioned since the Bretton Woods system established dollar dominance in 1944. When a country buys gold on international markets, the transaction clears through dollar-denominated exchanges. Even if the physical gold never moves, the financial settlement happens in dollars through banks that operate under U.S. jurisdiction and U.S. sanctions authority. What Russia and China just did is construct a parallel settlement system that bypasses that entire structure. The gold moves physically from Russian vaults to Chinese vaults. The payment moves digitally from Chinese banks to Russian accounts in yuan. No dollar touches the transaction. No American bank processes the clearing. No U.S. regulatory body has visibility into the transfer beyond what Russia and China choose to disclose. And most importantly, no U.S. sanctions mechanism has leverage over the deal because the dollar is not involved at any stage. The contradiction is stark. The United States has spent 2 years attempting to isolate Russia financially through the most comprehensive sanctions regime ever deployed against a major economy. The explicit goal was to cut Russia off from international capital markets and force commodity transactions into dollar channels where they could be monitored, restricted, or blocked. That strategy assumed Russia had no alternative settlement mechanism for large-scale trade. The $240 billion gold transfer proves that assumption was wrong. But here is the dimension almost no one is discussing. This is not actually about gold. Gold is the test case. It is the proof of concept. What Russia and China are demonstrating is that any commodity, any asset class, any major financial transfer can be structured outside the dollar system if both parties agree to accept an alternative settlement currency and have the infrastructure to clear the transaction. Gold was chosen first because it is universally recognized as a store of value, it is physically transferable, and its pricing is transparent enough that both sides can agree on valuation without reference to dollar-based exchanges. The technical architecture behind this matters. China has spent the last decade building the cross-border interbank payment system, known as CIPS. It is a WAN-denominated alternative to SWIFT, the messaging system that handles the majority of international financial transactions. CIPS currently processes approximately 12 trillion in annual transaction volume. That is small compared to SWIFT's 150 trillion, but it is functional, secure, and fully operational. When Russia transfers gold to China and receives yuan in return, the financial settlement happens through CIPS. No American institution is involved. No SWIFT message is generated. The transaction is invisible to the U.S. financial surveillance architecture. Russia, for its part, has been stockpiling gold since 2014, immediately following the annexation of Crimea and the first round of Western sanctions. Over the past decade, the Russian central bank increased its gold reserves from 1,040 tons to more than 2,300 tons. That makes Russia the fifth largest holder of gold reserves in the world. But unlike the United States, which holds gold primarily as a legacy asset from the Bretton Woods era, Russia accumulated its gold specifically as a sanctions hedge. The entire strategy was designed around the possibility that access to dollar markets would be restricted or severed. And now that scenario has materialized, Russia has the reserves to execute large-scale transactions without needing dollars. Here is what they are not telling you. This deal did not happen in a vacuum. It is the culmination of negotiations that began in October of last year, when Russian Finance Minister Anton Silvanov met with Chinese Vice Premier He Lifeng in Beijing. That meeting was not widely reported. The readout described discussions on trade facilitation and financial cooperation. What actually happened, according to individuals familiar with the talks, was an explicit agreement to pilot a non-dollar commodity settlement framework using gold as the first test. The 8-month gap between that meeting and the March announcement was spent building the legal structure, verifying reserve authenticity, establishing custody protocols, and stress testing the CIPS infrastructure to handle transactions of this scale. The timing is not coincidental. 3 weeks before the Russia-China announcement, Saudi Arabia let its 50-year petrodollar agreement with the United States expire without renewal. That agreement, signed in 1974, committed Saudi Arabia to price its oil exports exclusively in dollars in exchange for U.S. military protection and access to American weapon systems. Its expiration means Saudi Arabia is now free to accept payment for oil in yuan, euros, or any other currency a buyer offers. The kingdom has not yet executed a major non-dollar oil transaction, but the fact that the option is now available represents a structural shift in how energy markets can operate. Connect those two data points. Russia demonstrates that gold can trade outside the dollar system. Saudi Arabia signals that oil could follow the same path. These are the two most critical commodity classes in the global economy. If both can be transacted in alternative currencies, the entire foundation of dollar dominance begins to crack. And that is not speculation. That is the strategic calculation happening in Moscow, Beijing, and Riyadh right now. Now let me show you the math that explains why this is not just symbolically significant, but economically unsustainable for the United States if the trend continues. The dollar's role as the global reserve currency provides the United States with what economists call exorbitant privilege. It means the U.S. can run persistent trade deficits, issue debt at lower interest rates than economic fundamentals would otherwise allow, and deploy financial sanctions as a foreign policy tool because the majority of international transactions ultimately clear through dollar-based systems. That privilege has a measurable value. Estimates vary, but the most credible analyses suggest the reserve currency status saves the United States approximately $300 billion per year in borrowing costs. That is $300 billion the government does not have to pay in interest because foreign central banks are willing to accept lower yields on dollar-denominated assets in exchange for liquidity and security. It is a structural subsidy that exists only as long as the dollar remains indispensable for international trade. Here's the asymmetry. The global commodity market is valued at approximately $20 trillion annually. Oil accounts for roughly $4 trillion of that. Gold, metals, and minerals account for another $3 trillion. Agricultural products add $2 trillion. If even 20% of that total shifts to non-dollar settlement over the next 5 years, you're looking at $4 trillion in annual transactions that no longer require dollar liquidity. That reduces global demand for dollars. Reduced demand means downward pressure on the dollar's value. A weaker dollar means higher import costs for American consumers and higher interest rates to attract continued foreign investment in U.S. debt. Run the numbers. The U.S. currently imports $8 trillion in goods annually. A 10% depreciation of the dollar driven by reduced reserve demand increases the cost of those imports by $380 billion. That cost gets absorbed by American households through higher prices on electronics, clothing, vehicles, and energy. Inflation does not care about the geopolitical cause. It just shows up at the register. But the cost asymmetry runs deeper. The United States has $34 trillion in national debt. Approximately 30% of that debt is held by foreign entities, primarily foreign central banks, that need dollar-denominated assets to facilitate trade. If the volume of dollar-required trade declines because commodities start clearing in yuan or other currencies, those central banks need fewer dollar assets. They start selling U.S. treasuries. Reduced demand for treasuries means higher yields to attract buyers. Every 1% increase in the average interest rate on U.S. debt costs the government $340 billion per year in additional interest payments. That is $340 billion that does not go to infrastructure, defense, or social programs. It goes to bondholders. Compare that to the cost for China and Russia to operate outside the dollar system. For China, the cost is negligible. The country already holds $3 trillion in foreign exchange reserves. Shifting a portion of bilateral trade with Russia to yuan settlement does not require new infrastructure. SIPS is already built. The cost is effectively zero. For Russia, the cost is equally minimal. The country is already excluded from dollar markets due to sanctions. Moving gold transactions to yuan does not impose new restrictions. It simply formalizes an alternative that Russia was forced to develop anyway. The math is brutal. The United States pays $300 billion per year in reduced efficiency and increased debt servicing costs if reserve currency demand declines. China and Russia pay effectively nothing to operate a parallel system. That is not a sustainable equilibrium, and it is why this gold deal is not just a transaction. It is a signal that the infrastructure for an alternative financial architecture is operational and scalable. Let me show you why this fits into a broader pattern that has been building for a decade and is now accelerating. China's leadership has described the current international system as one that no longer reflects the economic reality of a multipolar world. That is diplomatic language. What it means in practical terms is that China believes the dollar's dominance gives the United States disproportionate power to set rules, enforce compliance, and weaponize access to financial markets in ways that serve American interests at the expense of others. The Belt and Road Initiative, launched in 2013, was China's first major attempt to build economic leverage that did not depend on Western financial infrastructure. It financed infrastructure projects across Asia, Africa, and Europe using yuan-denominated loans that required no dollar intermediation. The initiative has committed more than $1 trillion in financing over the past decade. Not all of it has been successful, but the strategic goal was never just about roads and ports. It was about creating trade corridors where Chinese currency could circulate without converting to dollars. Russia's calculation is different but complementary. Since 2014, Moscow has operated under the assumption that full integration with Western financial markets is no longer possible, and that attempting to maintain access through compromise is a losing strategy. The response has been systematic de-dollarization. Russia reduced its dollar-denominated reserves from 46% of total holdings in 2018 to less than 10% by 2021. It shifted trade settlements with China, India, and Turkey to local currencies wherever possible, and it accumulated gold as a hedge against the possibility that even non-dollar reserves could be frozen if held in Western banks. The gold deal is the logical next step in that strategy. It proves that large-scale commodity transactions can happen entirely outside the dollar ecosystem, and more importantly, it establishes a precedent. If Russia and China can execute a $240 billion gold transfer without dollars, there is no technical or legal barrier preventing them from doing the same with oil, natural gas, rare earth minerals, or any other commodity both countries trade. Here's the angle that should concern Washington most. The Global South is watching closely. For decades, countries in Africa, Latin America, and Southeast Asia operated under the assumption that integration with dollar-based markets was the only path to economic development. That assumption is being tested. If Russia and China can trade at scale without dollars and without triggering economic collapse, it demonstrates that alternatives exist. And once alternatives exist, leverage shifts. Saudi Arabia, the United Arab Emirates, and Brazil have all recently joined the BRICS economic bloc, which now represents 45% of the global population and 36% of global GDP, measured by purchasing power parity. The bloc's stated goal is to reduce dependence on the dollar for trade settlement. That used to be rhetorical. The Russia-China gold deal makes it operational. India, despite maintaining strategic ties with the United States, has continued to purchase Russian oil throughout the sanctions period. Those purchases are settled in rupees and rubles, not dollars. Turkey has maintained trade relationships with both NATO and Russia, using lira-ruble settlements to bypass dollar restrictions. These are not fringe economies. These are G20 members executing non-dollar trade at scale. The message transmitting to governments across the developing world is this: dollar dominance is a choice, not an inevitability. If you are willing to accept the friction costs of building alternative settlement infrastructure, you can reduce exposure to U.S. sanctions, Federal Reserve interest rate policy, and the political conditions that sometimes accompany access to dollar financing. That is a powerful message, and it is one that resonates most strongly with countries that have experienced IMF structural adjustment programs, dollar liquidity crises, or sanctions threats. Now here is where it gets even more interesting. China is not just building an alternative to the dollar system. It is building an alternative that offers specific advantages over the current system for certain types of transactions. SIP settlement is faster than SWIFT for yuan-denominated trades because it does not require currency conversion and operates on newer technology infrastructure. For countries trading heavily with China, direct yuan settlement reduces transaction costs and eliminates exchange rate risk on bilateral trade. Russia benefits from an entirely different angle. Under sanctions, Russia cannot access dollar clearing systems, but it still produces commodities the world needs: oil, natural gas, wheat, fertilizer, palladium, nickel. By accepting yuan for those exports, Russia maintains access to international purchasing power that can be used to buy Chinese manufactured goods, electronics, and machinery. It is a closed loop that requires no Western financial intermediation. The strategic implications are stark. The United States built its post-World War II dominance on two pillars: military primacy and financial centrality. The military pillar remains largely intact, though contested. The financial pillar is showing cracks. And unlike military power, which requires decades to build, financial infrastructure can be replicated in years if the political will and economic incentive align. China has the will. Russia has the incentive. And an increasing number of countries have both. The gold deal is the test proving the infrastructure works. What comes next is scale. Here are my 3 predictions with a clock attached. First, within 6 months, you will see the first major oil transaction between Russia and China settled entirely in yuan, with no dollar involvement. The structure is already being negotiated. The legal framework is being finalized. And both countries have stated publicly that energy trade diversification is a priority. That transaction will be the proof that what worked for gold works for energy. Second, within 12 months, at least one additional BRICS member state executes a commodity transaction using the SIP system for settlement. My bet is on Brazil selling soybeans to China in yuan, or South Africa selling platinum in rand-yuan swaps. The goal is not to replace the dollar overnight. It is to demonstrate that alternatives are viable and scalable. Third, within 18 months, the U.S. Treasury proposes new regulatory frameworks aimed at tracking and potentially restricting non-dollar commodity settlements by entities that interact with U.S. financial markets. The proposal will be framed as anti-money laundering or sanctions enforcement. What it actually represents is an acknowledgement that the U.S. is losing the ability to monitor transactions that used to be visible by default because they cleared through dollar systems. That regulatory response will confirm that Washington views this trend as a strategic threat. Drop your prediction in the comments. Which happens first, the Russia-China yuan oil deal, another BRICS nation joining the non-dollar commodity system, or a U.S. regulatory response attempting to claw back visibility? Tell me, because I read every single one, and the range of perspectives in this community consistently adds dimensions I had not considered. If this breakdown gave you a framework for understanding what is actually happening beneath the headlines, share it with one person who still thinks the dollar's global role is permanent and untouchable. The assumptions that held for 50 years are being tested in real time, and most people are not even aware the test is happening. The next video breaks down what happens to your mortgage rate, your retirement account, and your purchasing power if the dollar loses just 15% of its reserve currency share over the next decade. The math is not comforting, but it is honest. Subscribe so you are there when it drops.